Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, and Ben Kingsley, Chair of Property Investment Professionals of Australia, and the 2014 and 2015 Property Investment Advisor of the Year.
All right, folks, you're on the Property Couch, where each week Ben and I bring you the insider's guide to property investing. Welcome back to the couch, mate.
Thanks for having me, Bryce. It's just a real privilege to be working side by side with you.
You had to throw your Collingwood reference in there, didn't you, side by side? Hey, mate, how comfy is this couch?
Oh, well, if we actually were sitting on one.
Mate,
don't give away the gold.
The
showbiz.
People
do people realise that we're standing up? They've seen the photos, probably, of standing up around the mic.
We've left some room on the couch for some of the best guests in Australia. We've had some terrific ones this year.
Yeah, more to come.
Absolutely more to come. All right, mate, today my Mindset Minute is I'm trying to encourage my kids. You probably have this yourself, Ben, that whenever Jackson is in prep, he's reading like a champion. So I'm trying all the books. I think I told you I'm listening to a couple of podcasts on parenting. And all the books are saying, don't say good boy, Jack, say great reading, Jack. So sort of go for the activity rather than the person, because then the flip side is bad boy, you know. So my Mindset Minute theme is along that. You know, we want to play the ball, not the man. So today is a Zig Ziglar classic. Remember that failure is an event, not a person.
Totally.
So, and people often define the failure to be themselves, but it's not. It's just an event, so people can move on. So there we go, folks. Remember that if you've had a crack before, I think Tom Panos put something up this week that all winners were losers who tried one more time.
That's it.
How good is that?
Well, I mean, if you don't have a go, are you living?
No.
If you're not striving, if you're not... In seriousness, I mean, there's people in life who might go through that way, but for us, it's like, nothing ventured, nothing gained.
We've had a few failures, mate, but we're not going to let the grass grow under our feet. We'll have a go.
I've still got that $500,000 mistake in that first property that I sold, so there you go.
Mate,
growing every year.
I've certainly made some mistakes. Carrying too much debt through the GFC without adequate buffers was one of mine. So
there you go.
Make sure that, folks, you have strong buffers in your portfolio. But remember that failure is an event, not a person. So,
brilliant.
Zig Ziglar classic. All right, mate, today we're going to talk about
Q&A?
Q&A day.
Q&A day?
How excited are we that Q&A day?
Very good. We've got a little table in the room that we record in, and it is...
The coffee table on the couch.
The coffee table is absolutely chock-a-block with...
great questions.
Yeah. Like, we could probably do a Q&A every 48 hours and still not get through that block of questions. So some of these are going to be older because they're just piling up, but keep sending them in.
Well, a couple of things for the listeners is we love the Q&A, so we want to encourage them. If they're going to ask us questions about a specific location, we're not going to answer those, Ben, because we don't want to be liable for any sort of... We want to give principles for people to learn how to fish themselves. And also some of the questions, Ben, we've answered. In previous Q&A. So if yours hasn't specifically been answered, we feel like the principle has actually been covered. Okay, so my first one today, Ben, is more of a testimonial, but it's definitely worth reading out. Dear Property Couch team,
love a good testimonial, Bryce.
I'd love to remain anonymous, but I just wanted to say a massive thank you for helping my family avoid making a giant mistake with our financial future. Late last year, our accountant advised us that we should attend a property investing seminar about saving tax through investing. Like chumps, I'm quoting here, like chumps, we signed on the dotted line for a new build in X suburb. Let's not name the suburb. We were really excited about the purchase and it ignited a desire to learn more about investing, which led me to your podcast. Well, listening to podcast 84 on why you shouldn't invest in property literally made me feel sick in my stomach, as I mentally ticked off all the reasons why our decision was a bad one. It clicked that we had been sold a lemon by a spruiker. Luckily, we had insisted on using our own legal team, and they were able to get us out of the contract before the deal went unconditional, and I just cannot thank you both enough for helping us dodge this bullet. It has still left us in a bit of a pickle, as the advisors, in inverted commas, had organised a refinance which has now gone through for our family home and our other investment property, leaving us with about $200K of available equity. We are not sure what our borrowing power is, as our previous broker was also linked to the Spruikers, and we don't trust what they've told us. In your opinion, what should our next move be? Ideally, we'd like to invest in Melbourne or Sydney, but I'm not sure if it's the right time to get into these markets. Once again, thank you sincerely for revealing the hard truth to us. It was difficult to listen to the home truths, but I'm glad I did, because these 20 minutes meant we have now avoided years of financial regret. Anonymous.
Thank you, Anonymous. Thank you very much. And look, it's a great message for everyone out there. When you go along to seminars and workshops and listen to podcasts, because there's also, we've noticed there's, a lot more property podcasts that are coming on air, and, obviously, it is a marketing angle for some, which is fine. The reality is that you can prepare and present an excellent 80% of your information is around mindset, taking action, how easy it is, how cheap it can be, the tax benefits, the depreciation benefits, all of those things. And they are convincing. And in a lot of respects, they ring true. They absolutely ring true. If you think about our four, foundations: asset selection, borrowing power, cash flow management, and defence, they are telling the story, and in a way they're sort of leading you to the conclusion that what they're offering is worthwhile considering. So the question then is of the 20% that is questionable, what are the things you want to be looking for? Again, sign on the night. If there's really pressure, if there's real advantages, they're stacking the value, $90,000 worth of value, you can get it tonight for blah, or whatever it may be, scarcity, these opportunities won't last, those types of things. That's when just relax, breathe. If the opportunity is good enough today, it's good enough tomorrow.
Let's put a blanket rule out there on the couch, Ben. If anyone hears about a strategy today, they should never buy a property on the same day.
No, never. Just does not make sense. And if you're invited to go on a tour, to go and have a look at the properties, usually some of the tactics they'll use is put experienced people that have had success in the bus. They might be on the payroll as well. So you're talking to someone who's had success. Those are the types of marketing tactics and sales tactics to get you excited about the opportunity. They put on a big spread. They make it look like it's, you can live a fantastic lifestyle if you follow us on our journey. Those are the types of things that sort of should raise red flags.
Man, I've got a friend in my hometown with what you just said, who has actually been the person wheeled out as the testimonial, the success story.
Yeah.
And she's highly embarrassed now that she fell for that, because she went in with the right intentions, that person went in with the wrong intentions, and now she's concerned that her name is associated with someone who's now got questionable standing in the property investment community. So, mate, people who are put up as those pillars of success often are not realising what they're actually doing.
And if these people help hundreds and hundreds of people, there's going to be some success stories in there. The question is how reliable are those success stories? So, but by all means, there are professional operators who do work through seminar environments. We know of the Right Property Group is a perfect example of a very professional business that does that. And they speak the truths, and it's not hype. So, there's none of this, get up and, high five, run to the front of the room, grab $500, all of that type of, that's when you absolutely know you're in the wrong room.
It's a bit of banker with a W activity, isn't it?
Yeah, absolutely. So now coming back to Anonymous's, part about, okay, you've got $200,000 in available equity, should be getting into the Melbourne or Sydney market. Remember, markets within markets. So we've been active in sort of saying for the last few years we haven't been buying in the Sydney market, but that's not to say that there weren't opportunities in that market. We just didn't have the full-time resource in that market to uncover those off market, but there would have been some good buying opportunities. So we would never blanketly say not buying in a market, but when we're asked for general commentary in the media, because we can't get into specifics, they want a sound grab, they want a sound bite, we've got to basically say, oh look, we're a bit worried about Sydney or a bit worried about Melbourne or whatever it may be. So it's really important to understand, and that's where the concept of demand and supply and measuring the markets within markets is an important part of the research you should be doing, because like I've said, all markets have opportunities in them. It's just about sniffing them out.
Yeah, I agree, Ben. So I think that success when you're, investing or building a portfolio comes down to, number one, having the right mindset, Number 2, having the right strategy. Number 3, buying the right asset. Number 4, having the right mentors. And number 5, having the right network. And it's a combination of those things. And I think you're right. When you go to these seminars, some of those things look, the illusion of those things are actually there, but the fundamental there is the right asset. And quite often, you said 80% of it's right. They can get some of that other stuff right. They can be the mentor. Totally. They can have the strategies right in terms of property. They can have access to the right mindset. But if you get the wrong asset, for me, what do I do next? I would seek out an investment savvy mortgage broker to help you turn that released equity into a pre-approval that you can use. And then seek out an advisor that you trust who can help you build a portfolio, but run the agenda with no conflict of interest that has your outcome in mind, and reverse engineer something that's specifically tailored to you rather than a vanilla solution. So, but the first thing is an investment savvy mortgage broker.
So can I round that out and also remind everyone, I'm putting my Pippa hat on now, pippa.asn.com. Sorry, what am I saying?
.org.
I'll start that again. www.pippa.asn.au. So that is the website to go to. Now, when you land on the Pippa website, which is the Property Investment Professionals of Australia, which I am the chair of, it's a non-for-profit association. It's an association for the professional people who work in the industry. Now, the idea with that association is they work under a code of conduct. Now, that code of conduct is all about trying to put the client's best interests first, disclosing of commissions, not general disclosure, actual disclosure. So if people are earning a commission, they need to tell you up front what they're earning. So if they're not a member of that association, you've got to then ask, why aren't they a member? What is it that they're trying to hide from me? No such thing as a free lunch. So when you get onto that website, you can learn more about the association. But even more importantly, you can actually search in your area for accountants, you can search for mortgage brokers, you can search for qualified property investment advisors. And I always say you should be starting with a qualified property investment advisor because they should be looking at your personal circumstances and tailoring a need to that. Now, it's important. If you feel like you're getting steered into, shoehorned into a particular property transaction that sounds too good to be true or sound too easy, then obviously really ask lots and lots of questions. Because if they can answer those questions honestly and it makes common sense and it is easily understood by you, then continue to pursue them because obviously you can start to build trust that you're working with a professional advisor.
That website again is
pippa.asn.au. So check it out and you can talk to other qualified professionals in our industry. Okay, well, I've got one here from Andy.
I'll just say, Ben, too. We've interviewed heaps of our competitors. So
correct.
There's a catalogue of opportunities within our own podcast to go and find some people.
Go and find some of that. And the ones that we like to interview in the investment property space are Pippa members. It's really important to us that we get the best and brightest on the show. Okay, Andy writes, can you guys talk about the finance in the first 2 stages of property investing? And he's got example, I suspect, accumulation, consolidation, and what is involved, how everything works with the finance and loans, what to do with the loans, for accumulation stages, to consider stages, and onwards. So it's basically, I think what he's asking us here is, how do we go about understanding the numbers? Thanks for the great podcast, guys, and keeping up learning heaps. Andy. So where do we start there?
Really good question. I think the fundamental sort of bigger framework is that all things being equal, we have growth assets, we have balanced assets and yield assets to round out the portfolio. So those first, through the accumulation phase, typically you're going to have negative cash flow and higher LVR on your global portfolio. But over time, that global LVR will diminish through buying the right assets, but that really comes back to what we believe in, isn't it, Ben? That you've really got to cash flow, because anyone who has a material income in this country typically puts it in real estate. Let's be honest, their principal place of residence.
Yes.
And anyone who buys a property in this country, unless they're blessed with an inheritance or a property, a lotto win, they're getting a mortgage. So the principal piece in most households is the cash flow and the mortgage payment. So ultimately, that's what we want to do is comfortably leverage ourselves to a point where our cash flows will allow us to maintain it like quite as they right through that accumulation phase. But as we consolidate and the LVR starts to drop, then we can start to think about bringing more income assets into the portfolio to fully round that out.
Yeah, so we start with cash flow, and cash flow determines potentially the route that we take. Meaning that if we've got really, really strong surplus cash flows, yet we know that, as Bryce was just saying, there's 3 different types of properties. There's growth properties, there's balanced properties, and there's yield properties. What are we talking about there? With a growth property, traditionally there is a shortfall. There is a shortfall that we need to cover off. That's a negatively geared property when it first starts. Now, if that property is going to deliver you, say, a 7% compounding return over, say, a balanced property which is going to deliver you 5, and say a yield property which might be delivering you 3.5 to 4, over the course of 20 or 30 years, that is hundreds of thousands of dollars in difference in the power of compound. So naturally, we gravitate towards more of the capital growth properties as the way in which we would like to guide our clients. But if the cash flow isn't there, it's a different story. So to come back to your point around the accumulation piece, if you've bought well and the property prices have grown, usually your debt is not interest capitalising. That is a super aggressive strategy and a conversation for another day, because there's tax risks with that. So your debt's sort of remaining flat, but the value of the property is growing, and your rents are also being growing over time as well. So at some point in that conversation, that property will turn from negatively geared to being neutrally geared to eventually turning positively geared. Now,
do the politicians know about that?
Yeah, well, funny you should say. I've been doing some research because I've got a keynote talk coming up shortly, and the keynote's on housing affordability now. So we've always said negative gearing is a moment in time. That's all it is, and each time you measure that. And so I've done some rough numbers. 790,000 Australians who are claiming rental properties are positively geared.
Wow.
779,000, I think, from memory on the.
So roughly 2 million. So we're talking close to 40%.
So so it's basically 40-60. Now, obviously, if those people continue to hold those properties over time, that's going to grow. If they keep adding to their portfolio, though, this is the accumulation stage. If you keep adding, that one property sits there and that's going to do its thing and eventually turn positively geared. If you add another one property to that every 2 years, then you're still in accumulation phase. So you're still technically supporting that difference between the surplus cash and the shortfall and the surplus cash you're bringing into the household. So that's where the science and sophisticated cash flow modelling is absolutely critical, because you're trying to identify when is the appropriate time to add the next property into the portfolio, and that's why it's hard, and that's why we build a very detailed simulator to be able to do that for our clients. So we're trying to work that out. So usually your accumulation phase might last you 7 to 12 years, okay, where you're trying to build all of those properties in. Now, again, we've talked about you don't need 16, 20, 25 of them. You effectively need 4 to 5 really good ones, and they can be a combination of 2 or 3 growth and then a couple of one balanced and one yield. Because if you, and you think, well, turn that around, I'll just keep buying lots and lots of yield properties and I can keep going and going and going. You can, but just be mindful that if you're going to go in those locations, you need to bring your determination, because usually they're lower socioeconomic areas and you're going to have to do more in terms of managing those properties than what you would in buying in better locations. So it's just food for thought. So
that's an important point for people to land there, Ben.
Yeah.
Just, what you're saying is a game changer. They read the front page of the magazines and it's 10 properties in 10 minutes, 7 properties in 7 months. But you're actually saying, look, you can actually build this portfolio, make it 4 or 5, job's done, get on with it, and really do it in a conservative way.
Yeah, so, where we come back to this concept of you are traditionally going to work 40 odd years. So if, let's say, the first 10 years are dedicated to getting your family home and getting a bit of equity behind you, and then you've got basically 20 years where you're potentially focusing on that accumulation piece, so you're buying some of those properties, and then it is all those last 10 to 15 years of working is all about paying off that debt, but also seeing that the rent roll rising and also starting to pay that down. Now, when you retire, you may not be debt free. But that's okay because potentially the portfolio of properties is still delivering you enough income that's giving you obviously surplus passive income whilst also servicing the debt. So you would think that, in some examples, in some of the models that we build, if they retire at 65, there still might be $400,000 in outstanding mortgages, but it's against a $3.6 million portfolio. And that $3.6 million profit is generating in excess of the $20,000 or $25,000 I need to service that $400,000 mortgage. It's generating more like $80,000 or $90,000 or $100,000 in income. If that is the case, it's obviously then paying out the rest of that debt. So that combined with the compulsory super that we've been building up over time means that you're going to live very, very nicely in retirement.
Imagine that. Oh, very nice. All right, it was for me. It's kind of we've got one here from Jonathan in Facebook, Ben, but it doesn't need much more pondering other than just to acknowledge that we've got it. Because hi guys, I've recently started listening to your podcast and think it's great. I've recently attended a seminar with XYZ company, XYZ Education they call themselves. XYZ's obviously an artist. Just wanted to know whether you had heard anything about them. I understand there are many of these mentors out there. Those that are fee for service and those that work off commission. These guys are the latter. Any thoughts, comment would be greatly appreciated. Thanks in advance, Jonathan. I think it's just an extension of the previous one, other than to say, Ben, but it just really spells it out. There's fee for service and then there's commission. And if they're getting commission, they've got a conflict of interest if they're working for you.
Ultimately it is about that. I want to take this conversation a little bit further, Bryce, because part of the PIPA challenge we have out there is that there are, how spruikers potentially get around giving advice is they call themselves educators, right? Now, you can't go and see a financial planning educator. He's licensed. He's regulated. They can't go out there and say, I can sell you an education course and I can teach you how to do CFDs and contracts for difference, trading Forexes or picking the best stocks. They can't do that. They need a license. They're regulated to do that. Unfortunately, in the property market, it is unregulated. So we can see these people who really they're masquerading as educators, but what they are is marketers, or they might even be property investment advisors saying that they educate. Now, the challenge for us as an industry is to try and make sure that we can really separate those educators. Because if you are a true educator, then you should be part of an RTA or an RTO, a recognised training association or a recognised training authority. Now, if you are a true educator, then you should get a diploma or some type of certificate at the end of that course. So I always say to people who come across educators, mentors, coaches alike, the question is, what are the learning outcomes that you're going to get from the course? Is there a syllabus? Is there a framework? And are those the learning objectives? Do you have to sit an exam for comprehension? Or is it really just, no, follow me, I'm a great educator, I'm a great mentor, I'm a great coach, okay? Because if I'm going to follow an advisor or a mentor or a coach, I want them to have some type of formal qualification. I want to have some type of formal education or qualification that says to me that they can convey the appropriate message across. Because if I'm sitting there and saying, I'm going to mentor you, I'm going to mentor hundreds of people online or whatever, and assuming that I can give you 10 hours of mentoring and you're going to be a property expert, I'm not quite sure of that. So there are some really good ones out there. We know who they are. In terms of members of PIPA, and they do talk about learning outcomes. Margaret Lomas, perfect example with Destiny. So she's got some online courses, but she very much has learning outcomes that are associated with those as well. So it really is about looking at those. And if people want to be DIY, I absolutely good on you for being DIY and you're thinking you can save yourself some money by doing it yourself. Totally agree. But just make sure that they're not a university, or the property university, or the property club, or whatever it might look like. Those types of things are just difficult to understand in the sense that, are they true education, or really is it just a guise for marketing and selling your property?
Here. What's that? Is it me or you? That was just
I think it was me.
Yeah,
I think it's me now. Kate. What do you think about the idea of buying for cash flow only? Well, we covered a little bit that earlier. I live in Adelaide, and there are many areas within 60 to 90 minutes of Adelaide where you can buy quality, character properties for less than $250,000.
What?
Unbelievable. That's true. Okay. If only earning an average income and planning to buy and hold for 15 to 20 years, do you think a larger portfolio of properties like this may be less risky than one or two closer to the CBD, which have substantial holding costs? I think this is a really great question
I
from
think it's a
Kate.
good question too, because she talked about the fact that she's got lower income, which makes a difference. And,
yeah, it does make a big difference.
So, because we always say all things being equal, chase growth assets first. But in the case of Kate, that would be a challenge for her. I guess A, we need to define what our end goal is. B, we need to actually understand what that income looks like. But one of the things because as our listeners probably have picked up, we've helped our clients buy in Adelaide. And for me, I like to be in the security of Blue Ribbon Adelaide within close proximity, because what I know about the macro of that market is that it can be a little bit vulnerable. So I want to chase the market where the dentist, the doctor, the accountant, the sales executive, the small business owner, where they are a bit more in control of their income. So as I go a bit wider, I get nervous that these people can be vulnerable to a car factory, what do you call it, production line shutting down, or blue collar jobs. But having said that, I know people who have actually built portfolios where they are positive cash flow and they've built them up. But the other side of that is you have to have many of them, Ben. And so all I'll say is it's horses for courses. This may be the approach that Kate needs to take. But what I do know is that for the amount of people that I've come across who have got large portfolios with lots of properties, quite often they whisper in my ear and go, you know what, I'd really like to get rid of them all and just hold 4 or 5 really good ones. So it is an opportunity. But you're going to have to make sure that with lending changes, you're going to have to buy more, and it's probably going to be a little bit more high maintenance to maintain the portfolio.
It is, and what Kate's referring to when she talks about substantially higher holding costs, she's talking about servicing the mortgage, because we all know that with most properties there is going to be maintenance and repairs and upkeep for the property, so you're not going to get away with that. In some, there is a little bit more challenge in buying in some of these more lower socio-demographic areas in terms of pride of home and respect for one's property. Those types of things are just something you've got to be careful on. But if I was in Kate's position and I am looking to those particular locations, I'm looking at areas that I know that are going to stand the test of time. They are not going to be ghost towns or regional areas. 60 to 90 minutes, we're talking Victor Harbour, we're talking maybe Adelaide Hills, over in wine country. So if I'm talking about those particular locations and I had, and they were my choices, then absolutely I'm looking for character properties. I'm looking for well-built, solid, reliable and durable type properties that do still separate themselves from the rest of the market in that area, because if they are well maintained, they will attract a better tenant. Because even if I'm going to work in the wine industry and set myself up and learn my craft, I might rent there for a while because I might be spending two years in the Barossa, as an example. So I want to bring my family across. Well, having that nice home, and if these people are passionate about wine, they're usually got an interest in life and food and that, and so they'll be probably house proud. So they are good examples of buying these sort of nicer styled homes in those locations, as opposed to buying the dump in that particular area. So Kate, if that's the journey you're going on, the best news story for you is it's still more than likely going to be a positive journey.
Yeah, you bet.
It really is going to be, and for any other listeners who are saying, because we love helping those people who are less fortunate in terms of potential income and opportunity to be able to break that next ceiling, to get through that next level. So if that's moving, a household income from $60,000 to $80,000, and we're buying 1 or 2 properties where they just simply can't afford to buy 5 or 6, but we're moving them out of potentially 2 generations of lower socio-economic. That's a breakthrough moment, and those people Absolutely. Are then sending their kids to better opportunities and better locations. So good on you, Kate, if that's what you need to do. And for anyone who is trying that strategy, it works. But you've just got to be, there's going to be a little bit more work, a little bit more care around the tenants and the locations that you're picking, but it absolutely works.
Yeah, because you put some numbers to that, Ben, don't you? You go, say it's $100 a week positive, that's $5,000 a year. 3 of those, that's $15,000 a year. You may get 3 of those, which means that you then can afford the negative cash flow on one that's closer in. So it might just be that ratcheting strategy. But a key point is, do you think a larger portfolio of properties like this may be less risky? I think it's... I often see that it's not about how many properties you've got, it's the value, Ben. So if you want $100,000 worth of passive income, you need $2.5 million worth of income producing assets fully paid off outside of the family home, because at 4% there's your 100.
Yep.
So it's not really about the number of properties, it's about the value. So that's something to keep in mind as we're accumulating up to a value. If they're lower, we need at 250, we need 10 of those.
Correct.
Fully paid off. So that's a monumental task. But I agree with you. We want to break glass ceilings that people may have in their mind if that's going to help Kate get ahead.
And here's a little general tip for these types of locations. The closer you can get them to the outer metropolitan area, because the metropolitan area will grow, especially if we take a really, really long-term 15, 20, 25, 30-year vision on that. So if you are talking about buying on the fringes of Adelaide and it's going to absorb a little country town and be part of that, that's going to be, and you may be coastal side, or certainly you want to go down the wealth side. You don't want to go down the side that's got the lower socio-economic area. If you can do that, and if you think about 20 or 30 years time from now, so something like, Melbourne, Donnybrook, there's the train line that runs through Donnybrook. We're talking about eventually having fast rail that's going to run through that sort of particular area. Now, Donnybrook was a little, a dot on the ocean. That's those types of areas are eventually going to be absorbed by urban sprawl. And so if you're getting a nice character home in a pocket of that area, it will grow. It will not reduce in value. It's just not going to grow at the higher level because you are out wide and you don't have that sort of conveniences and all the lifestyle elements out there for you.
Very good, Ben. Very good. Okay, Eddie Ong has written in, "Hi, I'm an avid listener to your podcast. Started listening to them since 2015, but I've stopped for a year.
Oh.
I've recently...
That's okay.
Full stop. I've recently bought another investment unit and have started listening to them again. Ah, there we go. I'm currently at episode 51, and it's great. This is sort of a few months old, so it's probably a little bit further on. And it's great because I can listen to them non-stop with having to wait for the next one to arrive in my podcast. Great work. I really enjoy your shows. I have a question regarding Airbnb. I know it's not aligned with your property investing tactics and overall investing mantra, but recently it has taken the property market by storm, and there are many investors who are doing this to become positive cash flow. It is sort of the elephant in the room, and there is a lot of talk about it out there, whether it's the high-rise holiday resort or brick-and-mortar family homes. People are doing it. I've recently bought an apartment, yes, high-rise, high-density, tourist destination, lifts, caretaker, and so far I am positive cash flow after netting all costs, including cleaning, rates, and body corporate. I only manage the bookings of the apartment and outsource everything to a cleaner who doubles up as my meet and greet host. I also have insurances to cover those times when needed, and I do everything above board. I would like your views on how you look at Airbnb as part of an investment strategy, if it is something that you are interested in discussing. Thanks, Eddie.
Eddie, this is absolutely topical and will continue to be so as we see these types of disruptors. And I'll give you an example in our business. We've got Max, who's one of our developers based in Paris. He comes across every couple of years, a couple of times a year. And what do? We put him up in Airbnb so he can be close to our North Melbourne office. Perfect example. So we obviously use those services, and obviously someone set up a house or an apartment that allows us to come in and accommodate that. You've solved a lot of those problems by getting a conduit, someone who's going to caretake it and manage it for you, because that is the biggest problem here. Because you're trying to solve a bigger problem. To try and solve a bigger problem, you're expecting to get a better reward. By that I mean, and I've talked about this when it comes to developments, if you are willing to take on the bigger problem and solve it through subdivision and through value add, you'll get a better return. But it is not passive investing. It is not passive investing. And in this case, it's the same sort of thing. The cleaning, the maintenance, the damage, the parties, the noise complaints, all of those things need to be considered, because the opportunity cost, if you just looked at in outright, the outright opportunity cost is there is opportunity risk in the apartment that he's bought. High rise, probably not going to grow as well as getting a standalone or freestanding property that he might rent. So he's looking at it from a cash flow point of view, and that could be really great for him to keep on his accumulation phase of his property. But the alternative is, what is that property going to grow in value? Because if it's going to grow slowly at 3 or 4%, and you could have got something at 6 or 7, well, you're not going to have a bigger wealth base by that time. But for some people, it makes perfect sense. And if I've got a holiday home that I'm not using, hey, that's going to add to cash flow. So I'm going to have to fit it out, and they're going to obviously use my cutlery and everything like that. So it's like there's going to be breakages, there's going to be damage. So all of those things you've just got to factor in.
Yeah, Ben, I've seriously thought about Airbnb on. I've got a property that's 150 metres from the beach in southeast Queensland. But ultimately, at this stage of my life, with what we do in the business here and 2 young kids, I just didn't want that sort of extra headache.
Yep.
But I seriously considered it for the cash flow, and at another time, I may do that.
Yep.
So where they talk about here that it's not part of your mantra, it actually isn't not part of our mantra.
No.
It's just as long as the intent to buy the property is not based on Airbnb worthy, if it's got owner-occupier appeal, it has scarcity, it's investment grade, then all of a sudden it stacks up as being okay for Airbnb. But as you say, Ben, it's not passive.
No.
You've got to factor in your hourly rate, and if you want to go through that, well, then there's an opportunity to.
Yeah, just expect, you might get a call at 9 o'clock at night saying, hey, we've locked ourselves out, and, you might be in a state and you mightn't have any opportunity to help them in. So it's looking at all those smaller things. Oh, well, the caretaker is not available, so they can't get in contact with the caretaker. Then they want to ring you. They're all the challenges. I mean, we went to and stayed at a service department on the Gold Coast for AREC, didn't we? And we got there on Sunday morning.
The first speaker.
Right, we got there on Sunday morning, and it's like, it's not open.
Yeah.
And then so we ring the button and we get they open probably 9 o'clock, 9:15, still no show. We're still waiting there saying, so they are the types of experiences that you don't want those people to have, and you get the bad reviews. But we say the same thing. If people come in and we have a look at their portfolio and we think, oh, wow, that, how's that property performing for you? Oh, it's sort of on the fence. I don't know whether to keep it or not to keep it. We will review it and say, that's really close to the beach. Have you thought about maybe a different strategy to bring in some higher rental yield? What do you mean? Well, have you thought about, holiday letting it on stays, Airbnb, those types of things? Oh, right. Well, how does all that work? I said, how it works is you're obviously getting less occupancy, so sometimes less wear and tear. You're going to have to fully furnish it. So it's probably a $15,000, $20,000, injection into the property. That all of those items obviously would be depreciable. But it's then so do some research. Start to have a look around, and you might pick up $2,000 or $3,000 in extra income for that property. So all of a sudden, on balance, it's got a little bit of growth coming through, but now you've got a better yield coming through. That could work. And if you've got the time to manage it, in other words, if you're working from 9 to 5 and you've got some free time, then it could be a real opportunity for you. And if the property's around the corner from you,
yeah, I think that's the key, isn't it?
Even better.
If
it's interstate
that adds some complexity. Andrew and I stayed at a place in the Dandenongs.
Yep.
and had one of those little electric hot plates,
Yep.
and then the whole joint blew
yeah,
everything. Right?
Yeah.
So we're flicking the main switch wouldn't work. So we're ringing the owner, and we're in the Dandenongs, and she's interstate. Challenge. It was a fundamental thing that we needed.
Yeah.
So our view, Eddie, is on the big picture level.
Very open.
But the nuts and bolts need to be unpacked, I would say. Ben.
Yeah, if you're willing to solve those problems when they arise, then you'll get reward for that. But it is, again, that's not passive investing. You're going to have to be active,
exactly.
and it's a job. You've got to oversee the caretaker, and you've got to oversee the property on a more regular basis because of the transient number of people coming through the properties.
Very good, Ben. We love Q&A day. We could go on forever, but I think we'll leave it at that. We've answered a few good ones, but for me, let's talk about life hack today. Mine is about inbox zero, Ben.
Yes.
I'm keen to. I think
we're a little bit different on this, aren't we?
A little bit. But, I used to leave all of my emails in my inbox, and then people would come 37,000 emails. Like, yep, no problem. But I just use the search function. Now I implement inbox zero,
which is great.
But the overarching principle is most of us. Can you remember when you got your first email or those first few? It was exciting. No. Mate, I remember big pond, the dial-up.
Oh, yeah.
I just hoped someone had sent me an email. But now they're the bane of our life, But the challenge is often people come into the office and then they make their focus of their day their email. So effectively what they're doing is letting someone else's agenda run their day rather than their own agenda.
Say that again, because that's really important.
Yeah, it's critically important. I talk to the team here about it. You know, don't let other people's agendas run your day.
It's gold.
Work out what your day is first and then see if your agenda runs to that. So I implement this process called Inbox Zero, Ben. So I go in, takes me about 5-10 minutes in the morning, and I really categorize the inbox to the 5 Ds. I'm either going to defer it, delegate it, delete it, deposit, or do it.
Awesome.
So the defer is effectively, okay, we'll take a step back. If I'm an air flight controller, and I've got 7 planes, one from Perth, one from Dubai, they've all coming in, and they need to land at Melbourne Airport. Of course, as the air flight controller, I'm putting them into a holding pattern so they land one by one safely. Right?
Yes.
The challenge that we have with tasks is we get a task and your wife rings you and says, can you pick up a pizza on the way home? And then someone says, I need you to help me with this project. And we actually all try and land all of those planes at the same time and give them all the same priority, when in fact, they don't all need to be done now and they don't all have the same priority. But without a better system, that's what we do. So number 1, defer. Do I need to do this now or can I do it later? Bang. Number 2 is delegate. Do I need to do it or can someone else do it for me? Number 3 is delete. Is it relevant? Is it a newsletter that I've seen? I'm not going to refer to it before. 4 is deposit, which is effectively archive, but I needed a D word. So
love it.
If I want to keep it for future reference, I just put it into archive. And then the 5th one is do. If it's going to take me less than 2 minutes to do it there and then. Bang, give them the response. But if it's going to take me longer than 2 minutes and it's not the plane that I want to land right now, I defer it to another time. So there you go, folks. Inbox Zero. I check my emails typically twice a day, in the morning and in the evening.
Well, that makes a really important point, because where the time drain is so obviously I get a lot of emails coming in. I've got, I wear a few hats. So some of the emails that are coming in require a lot of thought and not an immediate response. Like, that's a big decision that involves, where to be clients or where So from that point of view, if I spend my day just quickly reading those, and then they take my train of thought away from the work that I needed to be productive on at that time. So I think that tip of twice a day, where you are, and then people understanding that, you always say never pick up the phone, when you check, it's because I'm the same with that. If I get distracted, when the work that I need to do actually has some brain power that needs to go into it. So I will predominantly defer a lot of things because I just want to think them through. So by looking at it twice a day, I don't want that taking up some of my, sort of subtle thinking going on behind the scenes. I want, I need to clear my head. So try not to get to those. So I think that's a great tip. And when, okay, that does need a bit more work, I'm going to go and put it into that folder.
Well, it's Michael Hyatt. Everyone knows I love Michael Hyatt. He's introduced me to these concepts, and he says that your brain is for creating, not storing. And the problem is we try and store things. So you get a text message that says, can you do this? Get someone coming. So all of a sudden you're going, I need to think about all these things rather than be creating. So clear the decks. And the same is with the inbox. If I've dealt with it in the morning, I don't want to be reminded all day as I look in the inbox to go, I haven't done that. I haven't done that. I haven't done it. I put it into a holding plane and I'll land the plane. It's the 5th plane I'm going to land. I'll worry about it when I've landed the other 4 planes. So there you go, folks. My life hacks today is to try and get Inbox Zero. Defer, delegate, delete, deposit, and do.
And you will have productivity gains like you wouldn't believe.
Did you know?
So just a couple of little fun facts today, just lighten the mood.
Good. I like it when you
here's just, obviously done a lot of work, mate. Just Googled interesting facts and got something come up, and now I'm just obviously ripping off some of the statements in here. But here we go. Fun fact. The world's oldest piece of chewing gum is over 9,000 years old.
What?
I need to explore
who records that?
Well, first of all, who went and, what did they, carbon dated?
And who found it underneath that U2 desk?
Imagine that little desk in the cave where the kids went. Anyway, so 9,000 years old, bit of chewing gum. All right, so here's a nutrition fact. Okay, here we go. Blueberries will not ripen until you pick them. So if you leave them on the tree, is it a tree?
Yes.
It's a plant? Whatever. They won't ripen. So you got to pick them before, not like the grapes, obviously. So blueberries are a little bit different.
I did not know that.
Let's change the pace a little bit.
Yeah.
Here we go. Did you know, Bryce, that sea otters hold hands when they sleep so they don't drift apart.
Oh, I didn't know that.
There you go.
There's one for you and Jane.
Isn't that amazing? Isn't that amazing? That's sea otters. They just hold hands whilst they sleep. Oh, that's nice. They don't spoon each other. They just hold hands, which is really nice. Okay, final one. Finish off. Did you know, Bryce, that the human thigh bone is stronger than cement?
No, I did not know.
So obviously, what we need to do is get a few of those human thigh bones, and they can. We don't need jackhammers anymore. We just basically use the thigh bone to.
Mate,
so there you go.
Mate, insightful. I think that's right up there with the sticky note for life hacks. A couple of those.
But you can jot them down in your certain book.
I can see people sort of going on the train at the moment, jogging, driving in the office, thinking, wow, they're insightful fellas.
I think you should have turned off probably about 3 minutes ago. Right?
Well, there we go, Ben. As we come to another conclusion of a Q&A day, we absolutely love it. We'd encourage you to send that through to us via info@thepropertycouch.com.au or any of our Facebook, any of our social media in any way. You can ask Ben on his social media. Chances are you won't get it to Ivers. Nope. If you ask me, you ask it to Ivers. We'll get those, and we love doing it. So,
and Bryce, finally, just remember, knowledge is empowering, but only if you act on it.
Very good, Ben. I love it. And until next week, folks.
See you later.